Hello there, this is Victor here. Welcome to the Intelligent Investor channel. Recently, Meta stock has recovered a lot right after the company released its Q4 earnings report. Mark Zuckerberg said, "Our management theme for 2023 is the year of efficiency, and we're focused on becoming a stronger and more nimble organization." Meta is increasing its share repurchase program by $40 billion. Meta's management finally understands what investors are looking for, which is cutting down operating expenses, reducing capex, and focusing more on Meta's app business instead of spending so much money on the metaverse business. As a result, Meta stock soared as much as 20% right after the Q4 earnings release. If you bought Meta stock near the bottom, the stock has almost doubled since then. To be fair, Meta stock is still down a lot from the most recent peak at $378 per share. So in this video, I'm going to talk about these topics to see whether Meta stock is really turning around now. First, Meta stock's biggest headwinds and risks. Second, is Meta stock really turning around or it's just recovering temporarily? Third, Meta stock's intrinsic value. And fourth, Meta stock rating. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog. I have posted a link in the video description. Once you become a Patreon member, you can follow all the stocks I'm buying every month, follow all the stocks I'm investing in for the long term, and download the latest intrinsic value calculator so you can estimate whether a stock is undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. I want to talk about Meta's biggest headwinds and risks first. In the past, Meta, formerly known as Facebook, did very well. For example, in the past 10 years, you can see Meta's revenue, operating income, earnings per share, and free cash flow grew substantially over time. Also, Facebook's daily active users have grown substantially over time. At the time of making this video, Facebook alone has more than 2 billion daily active users. If we include Facebook, Instagram, Messenger, and WhatsApp, Meta has around 2.96 billion daily active users. Right now, Meta is still facing these headwinds. First, the current slowdown in the advertising market is affecting Meta, Google, and all the major app platforms. Many advertisers have cut down their ad spending budgets because of high inflation, high interest rates, lower demand, and a possible recession in the upcoming months. Second, Apple's app tracking feature makes it a lot harder for Meta to target ads and measure ad performance with much less user data. Under Apple's app tracking transparency framework, users need to opt in and consent to allow apps to track their activities across other companies' apps and websites. Of course, most people will opt out and not allow companies like Meta to track their activities across other companies' apps and websites. This is the biggest reason Meta's revenue decreased slightly year over year in 2022. According to Meta, Meta loses about 10 billion of ad revenues each year because of Apple's app tracking transparency framework. The third headwind is competition with TikTok. TikTok is still the most popular social media platform for short-form videos compared to Reels. Also, TikTok is very popular with younger users. The fourth headwind is that monetization on Reels is still in the very early stage. As of now, monetization on Reels is much lower than monetization on feed and stories. Meta believes that monetization on Reels will improve over time. And fifth, Meta is still investing heavily in the metaverse business every year. According to these financials here, Meta's Reality Labs or the metaverse business has been losing billions every quarter. Meta is essentially using family of apps operating profit to fund the metaverse business. The next computing platform is expected to be AR glasses and mixed reality headsets. Based on what I know, Mark Zuckerberg wants Meta to own the next computing platform and ecosystem, so that Meta's businesses will no longer depend on Apple's iOS ecosystem and Google's Android ecosystem. If Apple releases another major change to app tracking and data collection, Meta's app business will likely be impacted again in the future. Also, Apple is expected to release a mixed reality headset this year and eventually release AR glasses to compete with Meta. Meta wants to stay ahead of Apple to own the next computer platform and ecosystem. This is why Meta is investing billions in the metaverse business every year. The biggest downside is that we don't know when the metaverse business will become profitable. So is Meta or Facebook stock really turning around, or Meta is just recovering temporarily? In my opinion, I think Meta is likely turning around. Here's why. If we consider all the major headwinds I talked about earlier, Meta's ad revenue only decreased about 1% year over year in 2022. Also in Q4, Meta's ad revenue only decreased about 4% year over year. This revenue decrease is much less than what the market initially expected. I think this shows that Meta's app business is much more resilient even after Apple introduced an app tracking feature. More importantly, I think it shows that Meta's app business is likely turning around because of Meta's large investments in Reels and large investments in AI. AI actually helps Meta recommend better and more relevant content, increase user engagement, and improve ad performance for advertisers using much less user data. This from the most recent earnings call. Mark Zuckerberg talks about Meta's top priorities to turn the company around.
Now, before getting into our product priorities, I want to discuss my management theme for 2023, which is the year of efficiency. We closed last year with some difficult layoffs and restructuring some teams, and when we did this, I said clearly that this was the beginning of our focus on efficiency and not the end. And since then, we've taken some additional steps, like working with our infrastructure team on how to deliver our roadmap while spending less on CapEx. Next, we're working on flattening our org structure and removing some layers of middle management to make decisions faster, as well as deploying AI tools to help our engineers be more productive. As part of this, we're going to be more proactive about cutting projects that aren't performing or may no longer be as crucial, but my main focus is on increasing the efficiency of how we execute our top priorities. So I think that there's going to be some more that we can do to improve our productivity, speed, and cost structure, and by working on this over a sustained period, I think we'll both build a stronger technology company and become more profitable. Now next, I want to give some updates on our priority areas. Our priorities haven't changed since last year. The two major technological waves driving our roadmap are AI today and over the longer term, the metaverse. So first, let's talk about our AI discovery engine. Facebook and Instagram are shifting from being organized solely around people and accounts you follow to increasingly showing more relevant content recommended by our AI systems. And this covers every content format, which is something that makes our services unique. But we're especially focused on short-form video since Reels is growing so quickly. And I'm really proud of our progress here. Reels plays across Facebook and Instagram have more than doubled over the last year, while the social component of people resharing Reels has grown even faster and has more than doubled on both apps in just the last 6 months. The next bottleneck that we're focused on to continue growing Reels is improving monetization efficiency, or the revenue that's generated per minute of Reels watched. Currently, the monetization efficiency of Reels is much less than feed. So the more that Reels grows, even though it adds engagement to the system overall, it takes some time away from feed and we actually lose money. But people want to see more Reels, though. So the key to unlocking that is improving our monetization efficiency so that way we can show more Reels without losing increasing amounts of money. We're making progress here, and our monetization efficiency on Facebook has doubled in the past 6 months. In terms of the revenue headwind, we're still on track to be roughly neutral by the end of this year or maybe early next year. And then after that, we should be able to profitably grow Reels while keeping up with the demand that we see. In our broader ads business, we're continuing to invest in AI, and we're seeing our efforts pay off here. In the last quarter, advertisers saw over 20% more conversions than in the year before, and combined with a declining cost per acquisition, this has resulted in higher returns on ad spend. AI, it's the foundation of our discovery engine and our ads business, and we also think that it's going to enable many new products and additional transformations in our apps. Generative AI is an extremely exciting new area with so many different applications, and one of my goals for Meta is to build on our research to become a leader in generative AI in addition to our leading work in recommendation AI. Now, the last area that I want to talk about is the metaverse. We shipped Quest Pro at the end of last year. I'm really proud of it. It's the first mainstream mixed reality device, and we are setting the standard for the industry with our Meta reality system. Now, as always, the reason why we're focused on building these platforms is to deliver better social experiences than what's possible today on phones. And the value of MR is that you can experience the immersion and presence of VR while still being grounded in the physical world around you. Later this year, we're going to launch our next generation consumer headset, which will feature meta reality as well. And I expect that this is going to establish this technology as the baseline for all headsets going forward, and eventually, of course, for AR glasses as well.
This is from the most recent earnings release. Meta is planning to decrease operating expenses, reduce capital expenditures, reduce more middle managers, consolidate more office spaces, and invest in a new data center architecture that is more cost efficient, that can support both AI and non-AI workloads. Also, similar to other big tech companies, I think Meta will likely announce more layoffs in the upcoming months. In terms of outlook, Meta's revenue and earnings per share are expected to grow again, very likely starting in 2023 or 2024. Of course, this will largely depend on the advertising market and when interest rates will start to decrease again. This is from Seeking Alpha. According to the consensus revenue estimates here, Meta's revenue growth is expected to grow about 5% year-over-year in 2023. Then Meta's revenue is expected to grow again starting in 2024. According to the consensus earnings per share estimates here, Meta's EPS is expected to grow about 6.9% year-over-year in 2023. Then Meta's EPS is expected to grow at much higher rates starting in 2024. Now, these Wall Street consensus estimates are not always correct, but they're usually right about the company's revenue growth and EPS growth trend over the longer run. For example, if Meta is really turning around, many analysts will expect that Meta's revenue and EPS will start growing again over the next 5 years. I think this is the case here if you look at Meta's consensus revenue and EPS growth over the next 5 years. I want to show you one of my growth stock portfolios here. I also have other portfolios that have the same stocks and the same investing strategy. At the time of making this video, I don't have Meta stock in this portfolio here. I don't plan to buy Meta stock anytime soon because I want to invest in other high quality companies such as Microsoft, Google, Visa, MasterCard, American Express, and S&P Global first. I actually made a large mistake selling my Meta shares a few months ago when Meta stock was near the bottom. For example, I sold Meta stock and had a 7,000 gain here. My biggest mistake was not selling all my shares all at once when I was still making a gain. Then when Meta was near the bottom, I sold the remaining Meta shares and had a lost 17,000 loss because I made a mistake and thought Mark Zuckerberg cannot turn around Meta's advertising business. I initially thought Meta was becoming a value trap. I was wrong, so my overall loss in Meta is around $10,000. I also made the mistake of investing in too many hyper-growth stocks in the last 2 years when interest rates were low. I was fear of missing out. I will talk more about these investing mistakes in a separate video. Overall, this growth stock portfolio here is still doing fairly well, even in this high inflation market, because of my investments in Apple, Google, Microsoft, Visa, MasterCard, and Tesla. In the long run, I do expect this portfolio will grow substantially in value over time. I want to show you how to calculate Meta stock's intrinsic value per share here, so you will know when Meta stock becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Meta's intrinsic value as its future free cash flows discounted to the present day. I use a discount rate of 12% here. You can use a higher discount rate here if you want to be more conservative. Meta's most recent trailing 12 months of free cash flow is $18 billion. In this high inflation market where advertisers are slowing down their ad spending, we have to expect Meta to have very low revenue growth or no revenue growth in 2023. Then as inflation improves and interest rates start to decrease again, I believe advertisers will likely increase their ad spending again starting in 2024. There are 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're assuming Meta's free cash flow will not grow in 2023. Then we're forecasting its free cash flow will grow by about 10% each year over the next 5 years. If we forecast Meta's free cash flow over the next 5 years and discount the free cash flow to the present day, Meta's intrinsic value should be around $408 billion for the entire company or $154 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're assuming Meta's free cash flow will stay flat in 2023. Then we're forecasting its free cash flow will grow about 12.5% each year over the next several years. Then Meta's intrinsic value should be around $441 billion for the entire company or $167 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're assuming Meta's free cash flow will also stay flat in 2023. Then we're forecasting its free cash flow will grow by about 15% each year over the next several years. Then Meta's intrinsic value should be around $476 billion for the entire company, or $180 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Meta's intrinsic value should be around $167 per share. I also use this price to book valuation method to estimate Meta's fair intrinsic value, which should be around $622 billion for the entire company, or $236 per share. If we take the average of both valuation models here, Meta's intrinsic value should be around $201 per share. Just to compare, Morningstar estimated Meta's intrinsic value to be much higher at $260 per share. This means I believe Meta is still undervalued at the time of making this video. Here's my overall stock rating for Meta. If you look at this spreadsheet here, you can see there are 5 main criteria I always look at when I analyze each company. Under the economic mode rating, I will give Meta a Y economic mode because of Meta's network effects. Morningstar also gave Meta a Y economic mode rating. Meta has around 2.96 billion family daily active users across Facebook, Instagram, Messenger, and WhatsApp. In my opinion, I think it's very hard to find a social media platform that can replace Meta. The closest one is TikTok. Under the management rating here, I will give Meta a standard rating. Under the profitability rating here, I will give Meta a cash cow rating. Meta's business is still very profitable, even though Meta's margins have decreased a lot in recent quarters because of large investments in the metaverse and views. Under the mode trend rating, I will give Meta a stable mode trend rating. Under the risk and uncertainty rating, I will give Meta a high risk and uncertainty rating because of the headwinds I talk about in this video. Overall, I am giving Meta or Facebook a stock rating of A. This means I believe Meta will likely turn around going forward, and I don't think Meta stock is a value trap. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Research channel, and I will see you in the next video.